Hi everyone, welcome to today's focused discussion on a critical area within banking security, that is shell companies. These entities, often veiled in secrecy, pose significant risks to financial institutions. In this video, we will clearly define what constitutes a shell company, delve into the specific risks they present to banks, and identify common jurisdictions where these entities tend to be established. This knowledge is crucial for effective KYC, AML, and fraud prevention within your daily operations. Let's begin by establishing a clear definition. At its core, a shell company is a legally registered entity that possesses no genuine business operations, no significant assets, and often no physical presence or active employees. It exists primarily on paper. While not inherently illegal in all circumstances, their lack of economic substance makes them prime vehicles for illicit activities such as money laundering, tax evasion, and sanctions violations. The key differentiator is the absence of real business activity. Shell companies present a multitude of risks specifically for banking institutions. Firstly, they are frequently used to launder illicit funds, obscuring the origin of criminal proceeds through complex transactions. Secondly, they can be instrumental in facilitating fraud, acting as conduits for deceptive schemes. Engaging with shell companies can also lead to significant reputational damage for a bank if it becomes associated with financial crime. Furthermore, regulators are increasingly scrutinizing banks' dealings with such entities, leading to potential regulatory fines and penalties for inadequate due diligence. Let's examine the risk of money laundering in more detail. Shell companies can be easily used to move and layer illicit funds, making it incredibly difficult to trace the original source. Large, unexplained transactions flowing through these entities should immediately raise red flags. The lack of genuine business activity provides a perfect cover for injecting dirty money into the legitimate financial system. The risk of fraud is equally significant. Shell companies can be used to create and process fake invoices, facilitate phantom asset schemes, and act as intermediaries in various types of financial deception. Their opaque nature makes it challenging to verify the legitimacy of transactions and the underlying business rationale. Shell companies can also be exploited for sanctions evasion, allowing sanctioned individuals or entities to move funds and conduct business discreetly. This can expose your institution to severe penalties and reputational harm. Furthermore, dealing with shell companies without proper due diligence directly leads to regulatory non-compliance, as it violates fundamental KYC and AML requirements. As banking compliance professionals, identifying potential shell companies is paramount. Be vigilant for the following red flags: unusual or large transactions that lack a clear business purpose, complex ownership structures involving nominee directors or shareholders, registered addresses that are simply PO boxes or virtual offices with numerous other companies, a lack of online presence or physical premises, and inconsistencies in the information provided by the customer. While shell companies can technically be established anywhere, certain jurisdictions are more frequently associated with their formation due to factors like low tax rates, strict financial secrecy laws, and less stringent regulatory environments. These jurisdictions, often referred to as offshore financial centers or tax havens, can include regions in the Caribbean, Europe, and Asia. However, it's crucial to remember that shell companies can also exist in onshore jurisdictions, making thorough due diligence essential regardless of location. Effective detection of shell companies requires robust enhanced due diligence (EDD) procedures. This includes thorough verification of ultimate beneficial owners (UBOs), going beyond nominee structures. Implement sophisticated transaction monitoring systems to identify suspicious activity. Conduct thorough adverse media screening to uncover any negative information associated with the entity or its principals. In higher-risk scenarios, consider on-site visits if feasible to verify physical presence and operations. Thank you for joining us today for this important discussion on shell companies and their risks within the banking sector. We hope this video has provided you with valuable insights into identifying and mitigating these threats. Remember, vigilance and robust due diligence are your strongest defenses against financial crime. By staying informed and implementing effective KYC and AML procedures, we can collectively work towards a more secure financial environment. If you found this video informative, please like it, share it with your colleagues, and subscribe to our channel for more essential content on banking compliance and security. We also encourage you to share your feedback and any questions you may have in the comments section below. Your insights are valuable to our community.